Welcome to our next installment of LinkedIn Live here. Thank you guys so much for joining me. My name is Huber Bongolan, and I'm joined here today with my counterpart, Waikiki Paulino. Waikiki, say hi
Uh,
to people.
Hi, everyone. It's great to be back with you here. We had a great time in our last conversation, and this one is going to be just as exciting, just as interesting. We'll be talking about building resilience and mitigating risk, which is one of my favorite topics. Well, ladies and gentlemen, today we'll cover several things. We'll be speaking about news and events. But of course, we'll let you know who we are and what we do and how we help. We'll talk about financial risk mitigation, operational risks. Several months ahead, we'll try to give you a great snapshot of what it looks like in the future. We'll tell you about our companies and what we specialize in and who we've helped and how we've helped them. We'll give you some actionable takeaways. We want to make sure that you're not only listening and learning, but you have some action steps that you can implement in your business as you're moving forward in this market. And then we'll have a time of Q&A.
Excellent. So let's get straight into it. Let's start with some bios. Waikiki Paulino serves family office patriarchs, hedge fund principals, and institutional real estate investors with over 25 years of expertise in managing large-scale commercial real estate projects. With degrees in structural engineering, construction management, and advanced studies from New York City universities, he has overseen $4 billion in project budgets, leading the development and repositioning and renovation of 4.5 million square feet of high-rise multifamily, office, hotel, and retail spaces. Known for expertise in risk mitigation and due diligence, Waikiki has managed projects for esteemed clients like Brevet Capital, Hines Development, GE Capital, and Starwood Capital. Through his faith-based initiative, Kings in Christ, Waikiki is equally committed to fostering family legacy and community impact. Waikiki, thank you so much for joining me today.
And I'm having a great time. All right, my partner here, Huber Bongolan, he's the heavyweight champion, reigning from all the way from California, originally from the Philippines. Huber is he's a veteran in this industry. I think it's now going to be 15 years, 14 years currently, but he will reach his 15-year mark in real estate and commercial real estate finance itself. He has sourced over $3.5 billion in capital for many borrowers and a lot of successful projects. He leads capital markets for the tech-enabled CRE brokerage. He provides national access to debt mezzanine financing for diverse projects. He holds a dual master's degree, an MBA, and an MRED from USC. And he's licensed. He's a licensed mortgage or loan originator and a real estate broker. He's an active leader. He holds positions at ULI and FIRE, supporting CRE professionals and giving back to the community. Huber also manages a network of over 5,000 capital sources, facilitating land and acquisitions, construction, and permanent loan financing. One of my favorite guys.
Thank you, Waikiki. Now, let's get into it, guys. News and events. What's top of mind as we start 2025, right? It's no secret. I doubt anyone that's listening to this has been living under a rock that some of the main issues that are facing us today, tariffs and geopolitical tension. It's almost every morning that I wake up, there's something new in the news in regards to one of these two policies. So it'll be very interesting to see how much of this plays out. We'll go into it in a little bit more detail. But of course, with both these factors, tariffs and geopolitical tension, you can expect much more volatility in the market. If tariffs continue in the pathway that we are seeing currently, there is a fear in the market of inflation reaccelerating, inflation going up. As everyone knows, that has been the battle over the past 2 years. It's playing with interest rates, playing with monetary policy in order to get inflation back under control. Now we're kind of in that realm of inflation being sub 3%. However, with the current discussion of what's happening with tariffs and geopolitical tensions, there's fear that inflation may or may not reaccelerate. A new concept that we've heard in the past, but is starting to gain more tractions, especially at networking events I've been a part of recently, is the concept of stagflation. So for those that know, inflation is when prices go up. Stagflation is when you have a combination of prices going up as well as the economy stagnating out. So whether employment going up or wages stagnating or going down or recessionary fears on the horizon, that combination of higher prices and a stagnant economy is where we see stagflation. So I'm not saying that we're in a period of stagflation. All I'm saying is that it's starting to come up in conversation more as a fear for what's on the horizon. Another concept in tandem with inflation that we've discussed a lot over the past 2 years is interest rates. Where are they going? What's happening with them? There was a lot of great news in September of last year when we had our first cut in Fed interest rates. Of course, that's short-term financing. What we're starting to see after that is long-term financing going up. You almost have like that K-shaped divide where long-term financing had been going up over the past couple of months, and short-term interest rates, the federal interest rates going down. It's we'll get into it next, but it's nice to see that these longer-term rates are starting to come back down for us and giving us some pricing relief. And I think the last thing when it comes to news and events that I'm seeing is this renewed optimism, but cautious optimism. I know that we've heard it a lot over the years, and it really feels true this year, where the mantra was survive until 25, and now we're in 25. So it's kind of cautious. Where are things going? There's a lot of volatility. What's happening? And that cautious optimism seems to remain kind of the phrase of the year. So moving on from news and events, what we had talked about before, rate changes. From September to about a month ago, we started seeing that K-shaped divide in the markets where long-term rates were going up and short-term rates were going down through Fed action. Now, what we're seeing in the last month, and you see in this graph here, is the 10-year Treasury note, UST yields, is starting to float back down, which is a great sign for investors that are looking for long-term loans or permanent type financing. You're starting to see some pricing relief when it comes to like 5-year terms, 10-year term loans, and that is a great sign for us. So that's news, events, and a little bit more about rates and changes. Let me pass it over to Waikiki to discuss some other risk mitigation strategies.
Hubert, that was very, very interesting. If we had to survive in 25, I think the new term is going to be endure. Yeah. The person that's able to get through all of this is the one that endures through all of the turmoil. Let's talk a little bit about risk mitigation strategies in project planning. This is actually something that we're very, very proactive at here, and we focus on it for our clients throughout all of their projects and all their portfolios. Being proactive and focusing in on the due diligence, not only on the phases, on the phase 1s and 2s when you're doing the land discoveries and everything else, that the banks and everyone else requires you to do, but actually digging deeper into the due diligence of the personnel, the sponsor, the team that's associated with the project is incredibly important. So we like proactive risk mitigation strategies, and we implement that, of course, throughout the due diligence, the early phases, when you're mapping out the deal, if it meets, all of the underwriting criteria that you have and your mandates as you're looking at these projects. Then we start looking at realistic budgetings. We love to stress test all of the pro formas that are put in front of us. I think that the best sponsors that are out there really show their homework. They show their notes as they're scratching through all of the pro forma analysis, and they identify all the different areas where things could be stressed out and the project could fall short. When you're working with someone like that, that is really, really helpful. I saw that on an RV park that is plentiful. It has a lot of land, a lot of potential, and the developer showed me all of the stress analysis that he put that project through, and it mapped out really well. It was really impressive to see his homework. Contingency planning is an absolute necessary thing to do right now. You will always need to have some contingency factored in financially, and then also factored in terms of plan Bs and even thinking about some replacement people on the team, having them earlier on. So if some vendors, they fall short throughout the project lifecycle, just having some people that you can pick up the phone call and understand where their bandwidth is so that they can step in place of some of the people that fall short on the project, because it's, unfortunately, times like these, it's inevitable, right? Some people just don't have access to the additional capital. They can't fund, they can't come in on the capital raise, or on the execution side, sometimes people just fall short and they can't deliver on their deliverables for the project. So just having those backup plans is really essential at this time. Let's talk about a little bit deeper into the due diligence and getting into the what it looks like when you're evaluating the sponsor and the team. Um, I see it as hiring someone to help your capital grow, right? You're hiring a person on staff, you're hiring an expert, you're aligning yourself with another strategic partner, and you really want to understand who that partner is, not just the CEO or the executives that are going to come to the meetings and shake your hands and sit down and say everything is great, but you want to understand who that project manager is that is going to take that baton and move it across the finish line and know how to navigate the world of community affairs and know how to navigate the world of building department officials or architects and engineers that are infighting and they are over designing or not coordinating with each other and causing big issues throughout your project. Of course, on a value add, those things are really important, and you want to understand who it is that's executing on those projects and understand where they are in life. You know, are they transitioning from a divorce? Are they feeling great? Are they moving on the next chain, or are they taking on 3 or 4 projects at a time because the company or the sponsor can't afford to hire more people, and so they need to satisfy all those things. That really impacts your capital, and it impacts your investment. You'll also look at the site and the marketing conditions, the market conditions. We were actually talking to a developer in New York City in downtown Manhattan who was considering to buy a 700,000 square foot office building and converting that into a multifamily opportunity. Great building, great location. However, we spoke about number one was a stress test when we looked at the performer, but the second thing we looked at was the absorption rate. You know, there are 2 massive projects going up right at the same time in the same location, and so will the property be will it be stabilized quick enough? And we wanted to see what that threshold looked like. Was it stabilized in 6 months? Was it 12 months? Or what was the long run? Because the loan has to get paid back, and that's going to get paid back by the income that you're generating from the building. So we look for those kinds of red flags. And then, of course, contingency planning, understanding how to speak to the supply chain, how to understand what's happening in the market in terms of air conditioners or the parts and smarts or the things that are going to be inserted into your building and understand where that's at. So those are just some quick thoughts on risk mitigation, but they really do count on helping to save you and your
Right.
investment.
That makes a lot of sense. I mean, we'll jump into the financial risk mitigation, but one thing that you talked about that I just had this conversation today in regards to picking the right team and the sponsorship
Yeah,
team. There's a lot of focus today on, hey, the business plan sounds great, but do we believe that this team can pull it off? Are they
that's
the
right.
right mix of skill sets? And do they have the track record that gives us confidence as lenders or financiers to be able to say our money is in good hands and they'll be
That's
able
right.
to weather storms or figure out issues that may arise and will undoubtedly arise throughout the process.
Absolutely.
So when it
Are you
comes
finding
to,
that conversation coming up a lot more with the banks and the lenders that are actually looking to execute? Are they asking those types of questions even more?
yes, track record and then liquidity to weather financial storms. Those are a
Wow.
lot of conversations that are coming up today. And plays well into the next topic here in terms of financial risk mitigation. So here are some tips and tricks that I've seen, especially being executed very well in today's cycle and today's market environment. Financing and structuring that financing plays a huge role when it comes to risk mitigation. Being able to have flexible capital, strategic debt planning, and proactive cost forecasting, those all contribute to the resiliency of a project. And what we had talked about, do we think that this business plan is a good business plan? Do we think this team has the chops to be able to pull it off? Well, some of the things as a team you could be thinking about from a financing side is one, let's talk about interest rate hedging. It's very volatile right now. I think if you took a poll in the beginning of the year or late last year where interest rates were going to be in 2025, most people said they'd be lower. It was the Fed's promising us cuts. We survived 2024. Rates should be on their way down. If you take that same poll today, no one knows. You'll probably get 50-50. It might go up, it might go down. You have no idea. So what you can do is control and try to hedge and put yourself in a good position in case those violent fluctuations happen against your current business plan. So one is using rate caps. So purchasing rate caps, there's different firms that specialize in doing that financial instrument. You can purchase a rate cap that protects you from if you're in a variable or floating rate situation. Those caps, those ceilings, put a ceiling on how high your interest rate can go. So that's one way to hedge against interest rates going up. Another way, on the opposite direction, if interest rates go down, structuring in no prepayment penalties. As we all know, there's step down prepays, yield maintenance, defeasance, minimum yield. There's different types of prepays that lenders try to instill in order to protect their yield. Negotiating in at the jump or finding a lender, such as a credit union, that does not have prepayment penalties typically, that is your best bet to be able to getting out of a loan if rates go in the other direction, if they go down, and being able to capitalize on that market. Another one is being proactive on leasing and sales strategy. A lot of business plans now, like building to spec, unless you're an industrial or a data center, right? Building to spec is kind of hard for a lot of investment committees to wrap their heads around because of the volatility and a lot of unknowns in the current market. So if you have the ability, pre-lease or pre-selling, getting those LOIs and MOUs underneath your belt so that way you can show to a lender that your business plan has that potential exit strategy is great and music to our ears on the financing side if you're able to get those. And then the last one, number 3, is optimizing your loan guarantees and recourse. So as a lender, they will always ask for recourse guarantees. They will always reach for everyone and try to get as many as they can because it puts them in a safer position. But as a tip is negotiate. That's all negotiable. So you can negotiate that on the front end and say, hey, maybe we don't want everyone on the team to guarantee. We only want this one person. How do we do that, right? Or what do you need in order to not have to personally guarantee? Now, not all lenders are the same, but sometimes it might just be, oh, you have to pay 25 or 50 more basis points and we can do non-recourse. You won't know unless you ask the question. So I'd say that a lot of my savvier clients these days are asking for how is the minimal amount of loan guarantees or partial or non-recourse can we negotiate on the front end. So that's some strategies on the financial and the risk mitigation front.
That is some great insight. That is absolutely great. I think that leads in well to the next conversation, operational risk.
Please.
When we navigate operational risk, we many times we're called in by the family or the hedge fund CEOs, and they ask us to look over the projects. One of the things that we love to look at are all of the proposals that were received by the developer during their time of development and putting the deal together. Not just the pro forma, not just the business plan, but we also like to look at the backup. What does that indicate to us? It tells us that one, the developer or the sponsor had some diligence himself, and he went out and he had an open competitive bidding opportunity across all of the people that are on the team, including the architect, including the engineers, including the attorneys and everyone else. You want to look at those proposals because you can learn so much from reading those proposals, and you avoid the friends and family kind of scenarios, right? Where people tend to hire everyone that they've done business with and they've executed really well with. There's some times that relationship is a little too comfortable, and you see that impact some of the budgets and some of the things that are happening on the project. So a vendor selection and accountability exercise is important, and we like to see the backup. We ask for it. We find that the most successful developers and the people that really understand and know how to navigate that have no problem in sharing that information because there's no threat, right? They're solid on the deal. They understand the deal. They know that it's going to work, and they've gone through all of the steps to make sure that it does work to protect the investor's capital. So asking for that is really important. We do the same, for the contractors, right? We sit in the meetings with these contractors and we hear what they have to say. We advocate that the owner has the opportunity to do that, or the investor has the opportunity to do that. Sit in some of those meetings. You don't want to sit in every one of those meetings, but if you sit in some of those meetings, you will learn so much about the project. You will understand the different ways to approach the project, the constructability issues that come up, the different ways to skin a cat, per se, right? And all of the tricks of the trade and where the money is hidden, you will find that through these conversations, right? So if you get a lump sum or a GMP from a contractor, a general contractor, but you're reading through the documents and you're sitting down in some of these meetings, you understand that, the concrete shouldn't be that expensive, but it is that expensive because of X, Y, Z. Maybe it's logistics, maybe it's the foundation or the sequence of the things that are going together. And there's some ways to find some cost savings, which of course a sponsor will absolutely find and look for you. But there's some ways to help yourself as you're looking to minimize your risk and your exposure through the operational program, where we see a lot of the challenges happen, right? When people can't complete the project or they can't execute well, you'll learn a lot from the team as they're asking questions of the vendors, right? You'll get to understand, does this person really know what they're asking, or are they just looking at a number, not asking for the backup of the schedule and how they're planning to get from A to Z? You'll learn a lot. So we enjoy those conversations. Um, and then, a really great exercise that we do, a very strong strategy, is to track the budget real time. We will walk the project site, we'll walk through, and it's not just walking through, an hour and you go top to bottom, you look with binoculars, but you're walking through the project and you're tracking with the budget in hand and the schedule in hand and seeing where the cash flow is actually mapping out. Um, some lenders call it construction monitoring, but unfortunately, some of the construction monitors that come to the project site really can't tell a piece of sheetrock from a piece of plywood, and they're confused. They're asking more questions of the contractor, and they really don't know how to dig in the details. And so having people that really understand the details and nooks and crannies makes a huge difference.
Yeah, like what you're saying. I mean, it seems like if have to put in one word, experience. And like that
Yes,
experience makes a huge difference for some of this operational risk strategies.
absolutely. And then when you hire someone that's already gone through all of those scar tissue healing and all those trauma, you're essentially buying that experience, right? And you're shortcutting the learning curve. You don't want people to learn on your capital, right? You want them to come ready, seasoned with the experience.
Exactly. Exactly. So looking forward, let's talk about some of the things that are top of mind for the months ahead. Um, we actually started our conversation with this tariffs, inflation, and then kind of what that looks like for financiers. But as we all know, no surprise, new administration, the first 100 days are always so important. What happens in those first 100 days? So in the months ahead, we'll be hitting that 100-day mark and we'll be able to assess a lot of the changes that are put in place, what was talked, what was actually put in and moving forward with. So that'd be very interesting to see. Tariffs, how much of this is just posturing? How much of it is talk? How much of it is negotiation strategy versus how much of it is real? And how much of it will Americans, the normal consumers, see in terms of prices going up? And then that leads into inflation, right? Where's the pain going to be? And what things will prices go up? And what things will prices stay the same? Those are question marks and things that we'll be looking for in the months ahead. And then lastly, as you remember that graph, that 10-year treasury coming down over the last 30 days, what does the next 60 days look like? What does the next 90 days look like? I saw a report that there's about, over the next couple of years, over $440 billion worth of loans coming to maturity. Something's going to have to happen then. A lot of those are long-term loans that need to be refinanced to another long-term loan where that treasury yield really has an effect. Or will they need to go short-term loan until things normalize in the interest rate market? So these will be some of the things that we look forward to and are watching very closely in the next couple of months. But from our discussion, right, what can you control? Those are some things that are out of our control. And let's talk about what are some actionable takeaways of things that are in our control as real estate investors, real estate professionals. And one of them, the first thing you'll see there is engage in early due diligence. Give Waikiki a call if you have questions on the operational front. Give me a call if you have questions on the financing front, right? As you start thinking and ideating on your business plan, some of these things that we're telling you today we can help you implement from the beginning to help you have a smooth kind of process during your zoning, your due diligence, your approval entitlement process. Number two that you see there is structuring financing with flexibility. I can't say it enough. Volatility is the theme of 2025. So having business plans that can be adaptable, that can be resilient, where you can pivot and give you optionality. Those are things that you want to look for and negotiate upfront when it comes to structuring your financing and your capital stack. Number three that you see there, implementing real-time project tracking. Prop tech technologies, they're abundant. It's almost like which ones do I use, right? And that's where I call Waikiki in terms of, hey, help me manage this budget. Things are going to change. I need to be using the right technology, the most seamless technology to be tracking my project and changes that happen in real time. So that way I can adapt in real time. Number four that you see there, conducting regular asset reviews. Asset management can be critical. How can you make your projects more efficient? I think we're all in agreement that cap rates, we don't know where they're going to go, but valuations may more that's more stabilized and have huge appreciations. So other than revenues, what you can make more efficient is your expenses. So being able to conduct those regular reviews of your assets and trying to figure out ways where you can be more efficient is a big takeaway. Where look at your portfolio, look at your deals, and maybe ask for help on where things can be more efficient. And then last thing that we talked about earlier, when it comes to the sponsorship team, and do they have the chops to pull it off, the experience, but do they also have that financial capacity we always talk about? Number five there, preparing cash reserves. So more liquidity, the better in an unknown, uncertain environment, right? If your deal plan is maybe on the fringe, it's not exactly on the fairway for lenders. It's kind of a maybe 60-40, 70-30 chance of getting approvals. Having a big cash reserve and having a lot of liquidity really helps put creditors' minds at ease that when trouble comes and when change is needed, you will have the cash reserves to be able to pivot and change your strategy based on future conditions. So those are some of the actionable takeaways. Waikiki, anything that I missed, anything that you want to stress in terms of some of these five here?
I think you did phenomenal. I would like to stress the word when trouble comes, right? It's not if, it's not just in case, it's when it comes. Everyone that's been in the real estate market for a long time understands that these things are inevitable. You can plan as much as you want, it all looks beautiful on paper, until trouble comes, right? And then we're scratching our heads. We don't want to be the people scratching our heads. We want to try to have as many plans in place, as many scenarios worked out in place so we can execute well.
That's right. So I love that. And with that, maybe tell us a little bit more about your firm.
Absolutely, I love to. But we're a intentionally boutique consulting firm. We are owners representatives. We help our clients through project management and through development management. We represent family offices, hedge funds, and institutional capital. We're experienced veterans. We've worked across many market sectors, from pharmaceutical through retail and residential and hospitality, and we've built a lot of projects from the ground up, as general contractors and also as developers. And so we have the experience to understand both the underwriting side all the way through transitioning to property management. And we love doing what we do. We come alongside owners and developers, and we help navigate through the process operationally. We've managed over $2.5 billion in project budgets, and we're currently overseeing $2 billion in master planning and due diligence and projects that are underway now. We provide clients end-to-end solutions from due diligence all the way through pre-development, team assembly, pre-construction, and forensic team studies to make sure that the teams are actually up to par for the project needs and the complexity. We love to partner and we love to serve with family offices because we think that you've worked really hard to earn that capital and to be able to establish a strong legacy, and we want you to succeed and not lose your family in the process of that success. It's our heartbeat. We love serving and helping to build portfolios, but not at the cost of family. And so if we can help and serve, we'd love to do so. Hubert, can you tell us about yourself and your
Excellent. Thank you,
business?
Waikiki. So credible CRE. We're meant to be your advisor on the financing side when it comes to commercial real estate. Our focus is to really help our clients secure the right capital, whether it be debt or equity, mezz, pref, any piece of the capital stack. We're here to help advise and help you structure that capital. As we discussed earlier, we have relationships with over 5,000 different capital sources across the United States. That could be your debt funds, your banks, credit unions, SBA agencies. My job is to help understand your business plan and put you in the right financial position for your deal to have the best chances of success. So for those that have a deal, please feel free to reach out. And for those that may have a deal in the future, please feel free to follow me. I put out a bi-weekly newsletter every Monday and Thursday. We've got 9,000 subscribers now. It's called CRE in 3, a 3-minute read, 3 headlines. It's what's going on the financing side of commercial real estate. What are the things that are top of mind for our industry professionals that you need to know, coming straight to your inbox? So feel free to reach out directly to me. Feel free to find us on our website, and happy to have you as part of our community. So with that, I think it's time for some Q&A. Here is our contact information here on the screen as reference, but I'd love to kick it off with a question for you, Waikiki. How do you advise your clients on handling distressed properties in today's market conditions?
Great question. We love to sit down and understand, first of all, the vision of the client. What is it that they're trying to accomplish, and how do they want to grow? Besides just looking at the deal that's put in front of us, we really want to understand what their investment mandate is, what their goals are for their family or for their business, and how to execute. Because not every deal fits their criteria and their vision long term for their business or their family. So I think that's a starting point. Once we get past that and we understand what the desire is of that family or the business, then we start guiding our clients through the due diligence phase. We will look at the underwriting. We will understand what's happening within the numbers and within everything that's being presented in the business plan. We try to identify things that are not being asked or being presented in the business plan, and so we have a very thorough due diligence time understanding the projects. I can give you an example. We looked at a repositioning project, again, the one that we spoke about downtown Manhattan. We were looking at that project. The numbers looked really nice, except it lacked the information on what the absorption rate was, and we were concerned with that. The projects, the numbers, the macroeconomics were really cool, but being able to fill that building in time, to satisfy that note was not reflected correctly. And so we told the owner, look, it may look good, it may look nice. Financially, the building, it's not an old building. It looks like a nice building. Some of the codes are still a little outdated. It needs to be revamped and redone. But um, let's talk about this a little bit further with the developer before we actually start moving forward on it. So that was one case study that was really helpful for them.
That makes sense.
Hubert, how do you structure financing in an environment of rising interest rates? How's that done? Well,
Yeah, great question. I mean, again, I think we talked about it earlier. I think some people are forecasting rising rates, some are hoping for lower rates. But if you're in the position where you think that rates are on the horizon going higher, then there's a couple of strategies. One would be short-term duration loans. So instead of locking in for 5 year, 10 year, try to get that 12-month loan, 24-month loan, so that puts you in a position to easily refinance and take advantage of a lower interest rate environment if it is. But if you think that rates are on the way up, then what I'd say is try to lock in at rates now with the flexibility of no prepayment penalty. That's probably the biggest thing that most of my investors are going after. Is, hey, how do I find a no prepay or a flexible prepay option? So that way, in the event that rates go up, I'm fine. I can keep my loan. In the events that rates go down, then I can refinance and get out of it. So I would say one of the themes of today's discussion is optionality. Look for flexibility because that will help you have the most resilient business plan. So,
phenomenal.
Waikiki, going on to your discussion earlier, can you share with us a recent project where due diligence played a key role?
Absolutely. There was a project in Manhattan. Again, it's a confidential project, but a family had approached us where they had a deal with a developer who was going to acquire the property at a certain time. So they had a current agreement in place, and the building was large enough that it could be subdivided right in the middle. There was an actual property line that could be drawn up and dividing the building. So the family had taken all of the tenants from one building and they moved them over to a new building, the adjoining building, um, and they identified how they can divide this building and build a high rise. The issue with the project was, one, there was a lot of historic asbestos and some things in the building that had to be cleaned up, environmental issues, and concerns for the demolition. There was also some contaminants on the ground that were identified, and so we wanted to identify a little bit more of the contaminants so that we can try to pinpoint and see where the majority of the cleanup would have to happen during this project program. The other thing that we identified was that the rock was very high and it had many fissures in it. And so, knowing some historical some historical work on a cleanup in a project on 76th Street, we understood that there are some of the contaminants can leak into the fissures of the rock, make its way into the water line, and then start contaminating a broader spectrum of the property site, making a larger cleanup project. And so we wanted to identify all of that within the business plan, and we couldn't find it. And the other thing we couldn't find was, how do we demolish the building, build a property line, and establish a solid demising wall so we're not disturbing the tenants that are next door. I mean, literally next door, and then building a 30-story building right next to it. So all of these mechanics, all of this logistical ideation and pre-planning had to be spoken about in the pro forma, in the budget, and in the execution of the project, which was lacking. So we helped the family understand the timeline, and then we helped them understand what their capital cost was going to look like, and then the waterfall, and when the developer actually got paid, and throughout that entire process. So I think it was helpful for that family.
That's incredible. I mean, the nuances that you're talking about is something that on my side I just don't see. I see that would probably be captured in contingency reserve, right?
That's
Or
right.
something renovation CapEx budget. And then we kind of give it a sniff test. And I'm like, does that number make sense? Yeah, it makes sense. But
Yeah.
for you, you're going into the detail of like what exactly are those dollars being used for. So
Sure.
fascinating.
Sure, I appreciate that because you're only saying that, yeah, this project is $350 a foot,
Yeah.
or it's
Yeah.
$400 a foot. Well, yeah, it's New York, it's probably a union pricing. Okay, but did you understand that the rock, there's underpinning, there's SOE,
No,
there's
I
support of
don't.
excavation. There's so much that goes into that $350 foot. And
Right.
there's so much that goes into even that $15 a foot that can blow up the deal if it's not managed well. So it's concerning sometimes.
Exactly. Nice.
Huber, here's a question for you. What should investors focus on when managing cash reserves? You mentioned cash reserves. I'd really love to hear your insight on this.
Yeah, I'll give a specific rule of thumb, like very actionable takeaway. So when it comes to cash reserves, everyone think whatever my post closing, like after I close and maybe there's a down payment if I'm purchasing a property or there's cash in that to put into refinance. After that cash is used in the closing process, how much cash do I have left over? And a good rule of thumb is that post closing liquidity, post closing cash should be about 10% of the loan amount or more. So just think of that as a rule of thumb. Lenders are different, credit committees are different, right? The way that risk is assessed is different. But think of that as a rule of thumb. What lenders don't want to see is, hey, after we close this deal, their liquidity is or close to zero, or it's insufficient. Even if we're structuring interest reserves, so on short-term duration loans, 12-month loans, 18-month construction loans, whatever it may be, it is typical that an interest reserve is structured. Well, then to sponsor them and be thinking, well, great, my interest is being accrued and I don't have to worry about really making those payments until a crystallization event on the back end. Either I'm selling it or I'm refinancing it out, and it's just numbers on a spreadsheet going up. That's kind of what I've seen with my clients, and I have to educate them on, yes, while that's true, interest is accruing, so not hard cash is leaving your account during the duration of the loan. Lenders on the front end still want to make sure that you have that additional liquidity. So just think of the rule of thumb, 10% of the loan amount after whatever is done and in the closing process, after that's being paid, having that in liquid reserves, 10% of the loan amount.
It's a challenging number sometimes. It's a big number sometimes for some people.
Yeah,
Um,
it's flexible. It's definitely flexible, especially when you're talking about big loan amounts. It's flexible, but just know that lenders will want to see it and they'll get more comfortable, and you have a much better time, much better chance of getting your financing if you have that number, or the team has that number, or the LLC has that number. It doesn't necessarily mean you personally have to have it, but there needs to be some way of showing that to a lender that, hey, we have it if we need it. Of course, our business plan's not going to call for it, but we have it in case we need to use it.
can we say if the imprest account has that number and take it away from the person?
Yeah,
Uh,
yeah,
sometimes they get the loan, but they have to make deposits sometimes.
right, exactly.
Uh, so, family, we want to thank you so much for sharing your time with us today. We hope that it was insightful for you. We really enjoyed putting this information out there and helping you navigate the next steps in your business and in your investments. And we're hoping to help you safeguard your investments, which is our goal. We want to see you being fruitful, but then also mitigating as much risk as you possibly can as you move forward. So we want to thank you for joining us today. We've discussed building resilience into your investment mandates, and then creating effective risk management, making sure that it's essential and it's top of mind for everyone on the project team, not just yourself. So that this way you can have some long-term success in your real estate investment. And whether you're navigating rising interest rates or preparing for future market shifts, proactive strategies are key. And we gave you some action steps. We'll post this on the live and we'll have this on our website. So that this way you can go ahead and look at them. And if you didn't take any notes, it'll be there for you. So you be free to download. If you're considering any ways to strengthen your investment approach, we're here to help you. please feel free to reach out. It's only a phone call. It is only an email that you'll be sending out, and we will respond happily. Forget about any costs or anything to that nature. We're looking out, so feel free to reach out. In fact, as a thank you for you joining us today, we're offering a free complimentary review of any proposal that you may have, or a business plan, or a financing plan. If you've watched this and you enjoyed it, and you have some questions, or you would like to start a conversation with us, please just send us an email. Use any one of these emails there and type in the word R25. If you type in R25, we know that it is your complimentary review of a business plan or proposal, and be happy to give you our comments and some feedback. So thank you very much for joining us. We hope to
Great.
see you on
Thanks,
the next
everyone.
one.
See you soon.